Hey everyone, welcome back to the channel. If you're new here, make sure to hit that subscribe button and turn on notifications because today we re-diving into something that could seriously impact your portfolio in the coming weeks. We're talking about two stocks that I believe present compelling opportunities right now, and I am going to break down exactly why you might want to consider adding them to your watch list before we head into the new year. Now, before we jump in, I have to give you the usual disclaimer. I'm not a financial advisor, and nothing I say here should be taken as personalized financial advice. This is purely educational content based on research and analysis, and you should always do your own due diligence and consult with a qualified financial professional before making any investment decisions. With that out of the way, let's get into it. So why am I focusing on stocks to buy before January? Well, there's something interesting that happens at the end of every year in the markets. We often see what's called the January effect, where stocks, particularly smaller cap stocks, tend to perform well in January after experiencing tax loss selling pressure in December. But beyond that seasonal pattern, we also looking at a market environment where certain sectors and companies are positioned for significant growth as we move into the new year. The key is identifying companies with strong fundamentals, solid growth prospects, and catalysts that could drive their stock prices higher in the near term. The first stock I want to talk about is in the technology sector, specifically in the artificial intelligence and cloud computing space. This company has been making waves with its innovative approach to AI infrastructure, and despite some volatility we've seen in tech stocks lately, the long-term trajectory for AI-focused companies remains incredibly strong. What makes this particular stock interesting is that it's not just riding the AI hype wave, it's actually generating real revenue from AI applications and has partnerships with major enterprise clients. The company's cloud services division has been growing at double-digit rates quarter over quarter, and analysts are projecting continued expansion as more businesses migrate their operations to cloud-based solutions and integrate AI into their workflows. One of the key catalysts to watch for is their upcoming earnings report in January, where market expectations are high for both revenue beats and forward guidance. The stock has actually pulled back about 15 to 20% from its recent highs, which I see as a potential entry point for investors who missed the earlier rally. The valuation, while not cheap by traditional metrics, is actually quite reasonable when you compare it to the growth rates we're seeing. The price-to-earnings ratio is elevated, sure, but when you look at the PEG ratio, which factors in growth, it's much more attractive than many of its peers in the same space. Now, what are the risks? Obviously, the tech sector can be volatile, and if we see broader market sell-offs or concerns about economic slowdown, high-growth tech stocks often get hit harder than the overall market. There's also competitive pressure in the AI space, with numerous companies fighting for market share. But here's why I think this particular company stands out. They've got a proven track record of execution, a strong balance sheet with plenty of cash and minimal debt, and they're already profitable, which is more than we can say for many AI companies that are still burning through cash. The management team has been transparent about their strategy and has consistently delivered on their promises to shareholders. Another factor to consider is institutional ownership. Major investment firms and hedge funds have been accumulating shares, which typically signals confidence in the company's future prospects. The smart money is positioning themselves, and that's always worth paying attention to. Let's move on to the second stock, which comes from a completely different sector, healthcare. Specifically, I'm looking at a pharmaceutical company that's in a really interesting position right now. This isn't some speculative biotech with pipeline drugs that may or may not get FDA approval. This is an established company with multiple revenue-generating drugs already on the market, and they've got several new treatments moving through late-stage clinical trials that could be approved in early to mid-next year. The healthcare sector tends to be more defensive than tech, meaning it holds up better during market downturns because demand for healthcare products and services remains relatively stable regardless of economic conditions. People still need their medications whether the economy is booming or in recession. What is particularly compelling about this company is that they refocused on areas of high unmet medical need, including treatments for certain types of cancer and rare genetic disorders. When you've got drugs addressing conditions where there aren't many good treatment options available, you typically see strong pricing power and less competition. The stock has been trading in a relatively tight range for the past several months, and I think we're approaching a breakout point. There are a couple of catalysts on the horizon that could drive significant upward movement. First, they're expecting Phase 3 trial results for one of their key pipeline drugs, and early data has been very encouraging. If those final results meet or exceed expectations, we could see a substantial pop in the stock price. Second, there's potential for FDA approval of another drug in their pipeline early next year, which would add a new revenue stream and expand their market opportunity. The company has also been smart about capital allocation, using their strong cash flows to invest in research and development while also returning value to shareholders through dividends and share buybacks. The dividend yield isn't huge, maybe around 2 to 2.5%, but it's growing, and having that income component can help cushion volatility. From a valuation perspective, this stock is trading at a discount to many of its pharmaceutical peers when you look at metrics like price to sales and price to earnings ratios. Part of this is because the market hasn't fully priced in the potential of their pipeline drugs yet. There's skepticism, which is understandable in biotech and pharma because clinical trials can fail and FDA approvals are never guaranteed. But when you look at the scientific data, the strength of their intellectual property portfolio, and the expertise of their research team, the odds of success seem quite favorable. Analysts covering the stock have been raising their price targets, and the consensus estimate suggests potential upside of 30 to 40% over the next 12 months. Now, those are analyst projections, and we all know they're not always accurate, but it gives you a sense of where the smart money thinks this could be headed. What about risks with this healthcare play? Well, there's always regulatory risk in pharmaceuticals. The FDA could delay approvals or ask for additional studies. There's also pricing pressure in the healthcare sector, with ongoing debates about drug pricing and potential regulatory changes that could impact profitability. Competition is another factor as other companies are developing treatments in similar therapeutic areas. And of course, clinical trials could produce disappointing results, which would likely cause the stock to sell off. However, I think the risk-reward profile here is quite favorable. The company's existing product portfolio provides a solid foundation of revenue and cash flow, so they're not entirely dependent on pipeline success. They've got financial flexibility and a strong balance sheet, which means they can weather setbacks better than smaller, less established companies. So how should you approach these opportunities? First and foremost, size your positions appropriately based on your risk tolerance and overall portfolio allocation. These shouldn't be massive concentrated bets, but rather thoughtful additions to a diversified portfolio. Consider dollar cost averaging into positions rather than putting all your capital to work at once. Maybe start with a smaller initial position and add to it over time as your conviction grows and as the investment thesis plays out. Set realistic expectations about time frames and potential returns. These aren't get-rich-quick schemes, but rather companies that I believe have solid fundamentals and catalysts that could drive appreciation over the next 6 to 12 months and beyond. Also, pay attention to your entry points. Just because I am highlighting these stocks doesn't mean you should rush to buy them at any price. Look for pullbacks or consolidation periods that offer better risk-reward entry points. Use limit orders rather than market orders to ensure you're getting the price you want. One more thing I want to emphasize: stay informed and be willing to reassess your thesis as new information becomes available. Markets are dynamic and conditions can change. If the reasons you bought a stock are no longer valid, be willing to exit the position and move on. Do and fall in love with your investments or let ego prevent you from admitting when you're wrong. The best investors are the ones who can adapt and make rational decisions based on current information, rather than getting emotionally attached to positions. Before we wrap up, I want to hear from you. What sectors are you most interested in as we head into the new year? Are you more bullish on tech and growth stocks, or are you positioning more defensively in healthcare and consumer staples? Drop a comment below and let's get a conversation going. If you found this analysis helpful, please give this video a thumbs up. It really helps the channel grow and lets me know what kind of content you want to see more of. And of course, if you haven't already, Hit that subscribe button and turn on notifications so you don't miss future videos where I'll be covering more investment opportunities, market analysis, and portfolio strategies. Thanks so much for watching, and I'll see you in the next one. Until then, happy investing, and remember to always do your own research.